everyone, and welcome to 2025 Market Outlook. First of all, I'd like to wish everybody a happy new year. I know we're a little late in the new year.
Just a little.
Just a little.
It's not that bad.
But as many of you know, I
Sorry.
had kind of a rough start to 2025. That's not a Brian start, just a personal start. So it's taken me a little while to get together. So for those of you that have sent me well wishes, I really do appreciate all the wonderful thoughts you guys sent out to me on my mom. It really meant a lot to me. That being said, I want to start out talking about 2025 Market Outlook. I promised at the last client event that we were going to start doing webinars once a month. And this is the beginning. We thought kicking this off with a Market Outlook would be a good start to the year. We're going to start doing these every 4 to 6 weeks. We're going to be inviting you and your friends to join in. We're going to pick out topics that were sent into us, as well as anything in the news or any ideas that come across appointments that we think will be valuable to you.
But send them in. Send in ideas.
Yeah, we definitely want ideas because we've always believed that educating our clients have always been the best way that we can help. So education is going to be something that's going to be first and foremost in 2025. Starting out 10 themes, when we first started, Brian's always ahead of me. We kind of talked about the market. What do we think the market is? Well, if you looked at the first screen, as Brian went back to,
I put it back.
For 2025, you see that we picked a picture of a couple on a roller coaster. That should give you a little bit of an idea of what we think 2025 is going to look like. Doesn't mean they're having a bad time. They both have smiles on their face, but I have a feeling that while they were on the ride, there were a couple of times they were a little nervous. I think that's going to be a very common theme for 2025. So the concept of an amusement park is kind of like what we're focusing on. We have 10 themes that we're going to talk about in 2025. The first one's called optimism overload. Kind of excited for the experience and really excited, but like sometimes that excitement can be a little bit, a little misleading. Second, we're going to talk about the U.S. economy. Third, monetary policy, going over fixed policy, U.S. equities. We're going to talk about some sectors, mid-cap equities, as well as risk management, because we're always talking about managing risk, mitigating risk, right? So we've put all of these with a theme of an amusement park. So we're going to start out with optimism overload. Excited for the experience. What we found is that 2025 is showing a lot of optimism in the market. People are feeling so enthralled with what they think is going to happen. Since the election, they really feel there's going to be a big change. And I do agree that it's going to be a big change. I think we have a disruptor administration. To me, disruptor doesn't mean good or bad. It just means different.
Right.
And this over-optimism is kind of being shown in different areas. So if you look at small business confidence, that's the highest it's been in about, what, 8 years, Brian?
Since 1980.
Since 1980. So that's a really long time. And then CEO confidence is the highest level since 2022.
Yep.
And then consumer confidence, I think,
highest since fourth quarter 21, but investor confidence is the all-time high.
Yeah. So like,
crazy.
People are out there thinking to themselves, this is going to be great. And when people think this is going to be great, they maybe take on more risk than what they should, because we could see different kinds of headlines, right? So if you think about it, some positive headlines that we would love to see is that, the war between Russia and Ukraine is pretty much done. We see that DOGE winds up cutting into deficits dramatically, so the government stops wasting our money. I know, that's my opinion, but we're going to go with it. And that Mexico and Canada start helping with the immigration problem, and tariffs don't have to go into play. But there are also some negative headlines that could happen. We could see the rise up of inflation again, right? And that would be an issue. The consumer could get tired of spending money, and that's really important because 70% of our GDP is a consumer. So we need that consumer to keep going on.
A slow in AI investment. I mean, AI investment has been just phenomenal for the economy.
And even though it can be a lot,
it could still be a lot. It could still be bigger than any investment in technology in history, but it still might be less than last year.
Right. Or it could be less than what the market is expecting. Right. And again, we do live in a pretty geopolitical, turbulent world. So wars could break out and that could be a problem. So all those things could create negative headlines. And with those positive and negative headlines, right, we have to worry about the different risks. Because there's a lot of famous people, I think about like Warren Buffett, right? He said, be fearful when others are greedy, and greedy only when others are fearful.
Right, that's my favorite one. You took my favorite one.
Oh, whatever. But the point of the story is that, you know, people can get over exuberant, and that can make the market may not be the best place to have all your eggs in, because
Right.
eventually people take profit.
Right, and when they do, when they're so excited about being positive on the market's going to go up so much that when it goes down, everybody says, holy crap, it can go down, and they all leave at once.
Yeah.
And when everyone leaves at once, that's when we get extreme volatility. That's when we get the roller coaster ride. That's the high highs and low lows.
Which we try not to avoid in our practice.
Right.
I want you to know my favorite one is if everybody is thinking alike, then somebody isn't thinking.
Well, then why didn't you use that one?
I don't know. I just thought.
Because you wanted to take my favorite one.
Since you said your favorite one.
Yeah.
So, famous investment, because a lot of you guys know we like these things. If you've been to our office in Rochester,
Yep.
You see we have them on the wall when you first walk in. We think there's a lot to be said in these really intelligent people telling us some of how the market works.
For sure.
That's you.
That's me. Okay. Well, the U.S. economy, safety check complete. This is where we are. Last year, the economy grew by 2.7%. Very strong growth. And this year we are anticipating, or analysts are anticipating 2.7% or 2.4% growth. So down just a little bit from last year, but still higher than average growth. So that's good for the economy. And what drives all that? 75% of our GDP is driven by consumer spending.
Yep.
And as the consumer makes so much of that push towards our economy and how it performs, if we get any little shortfalls or fallbacks in consumer sentiment, we could see more volatility.
Which is why the sentiment is pretty high, why they're expecting it to be positive.
Right.
But they don't really see a recession happening in the economy. That's really been taken off the table.
At this time, recession has been taken off the table. They do believe, they think inflation greater than 3% could be bad, but they don't think it's in the cards.
And they think even if it happens, it'll be very short term because of tariffs. Right?
Yep. So what we have here in the red is we have things that could make the economy not perform as well as they think. And the things in blue are things that could drive the economy to higher than anticipated levels. So, like we said, recession probably off the table. Negative job growth, that is unlikely.
Yeah.
Numbers came out again today. Fed over tightening, it doesn't appear that that's happened either. So now you always have the opportunity for a black swan event, right? We never know when something like that is going to happen.
That's really like a terrorist
attack or something like that you can, pandemic, global pandemic.
That's a black swan event.
Right? So we can't predict or know when those things are going to happen, and any of those type of things would be very bad for the economy and bad for the markets.
And a lot of people think maybe a credit event, but the truth is that our paper is still so wanted.
Yeah.
People are buying our paper left and right. So people still want our bonds.
The appetite for our market, for our paper is unbelievable.
Yeah.
So that's why, they put all these on here, right? We put all these on here, but then you listen to analysts and they believe that most of these have been taken off the table already.
Yeah, the other stuff, the stuff
that's the positive stuff, right? So what can drive us to maybe another big year? Not that we are planning for a big year, but there are some things that could hit the headlines or that could really drive the economy higher, and it'd be really healthy job growth. A resilient consumer that doesn't have any missteps and doesn't slow down their spending and continues to drive spending. Strong business investment, that's like continued AI investment like we talked about in the last one. If that AI investment continues to deepen and strengthen and speed up.
Which we just saw something happen that was really pretty big.
There was a bunch of money invested into it.
Yeah.
We'll see. Honestly, animal spirits.
That's like momentum investing, right?
Yeah.
Everybody wants to be in,
it's
so we go
FOMO,
in.
right?
Yeah.
You're missing out.
Yeah.
So if you've been on the sidelines for the last 2 years, afraid to get into this market and it continues to go farther, people want to be a part of that, and all of a sudden they dive in.
And I think this has a lot to do with like disruptor. That's kind of why I call this administration a disruptor administration, because really they can make the red happen or they can make the blue happen, but they're going to make something happen.
Honestly, they could make both happen in the same day.
Yeah.
They did.
Yeah.
They have. right?
Yeah, that is
So-
really true. So the point is that we could see a lot of motion, volatility,
Right.
and that is why we put that, roller coaster on there.
Yeah, and that's exactly it.
So drivers of future economic growth would be
Healthy consumer spending, reindustrialization, fiscal policy, more AI investment, deregulation. We haven't talked about that yet.
which is already started.
That's already underway, and the Fed continuing to ease the path on interest rates. Now, we got a pause, but a pause is not a raise.
No,
right?
It's not, right.
It's not a cut, it's not a raise. A pause is, let's take a breath. Let's let the economy mature. Let's let the economy figure out what it needs.
And it's kind of interesting, but the two stimulus bills that happened last year, 75% of that money hasn't even gone into the market yet.
Right.
So it's smart for the Fed to take that pause because we got to get that money in so we see how that money kind of gets through.
What impact it has on the economy.
Yeah.
That's the whole point of it.
So I think that's pretty important.
So, the majority of analysts are projecting that 2.4, but that's not slow. That's still better than average.
And honestly, it could be more than that. I mean, because again, this is a weird administration. This is an administration that is working at ridiculous pace and doing things that, honestly, I've never seen government do in my life.
No,
I don't think anybody.
I don't think anybody has. That's the disruptor piece.
The disruptor piece. So monetary policy, yeah. So when we talk about monetary policy, we're really talking about what the Fed's doing, right? And Brian alluded that the Fed took a pause. And the market always wants Fed rate cuts, right? That's what they say. Oh, give us another rate cut, give us another quarter point, because people got spoiled.
Right.
People like those rates of 2-3%. They didn't like it in their savings accounts when they were earning half of them.
No, they like the mortgages though.
Yeah, they do like the mortgages. They like
I
when
like
they can
the
borrow
mortgages
money.
too.
Yeah, well, I don't think you're going to see that again.
No.
So rates, historically, rates are not in a bad place right now.
No, that's what I was going to say. You don't think I'm likely to see that again? That would make sense.
Yeah.
Right? That was a historic low.
Yes.
We should probably not see that again in my lifetime.
Right. I don't think we will. I think rates are going to come down. It is predicted by analysts that we're going to see about 2 rate cuts this year.
Mm-hmm.
Not in the beginning of the year, really more towards the mid to end of the year.
Yep.
But 2 more rate cuts. And I think they're targeting the Fed funds rate at about, 4.5. I think it's on the next slide. 4%. So the Fed fund rate is about 4%. That's really the forecast for year end. And really to make it so that way, businesses can invest in their business with the deregulation and so forth, and the interest rates coming down a little bit.
Yep.
We can see business investment. And really the Fed is always trying to balance 2 areas. It's trying to balance employment and inflation, right? So as long as inflation remains in check and employment remains full employment, we're going to see the Fed funds rate right around 4 and the Fed won't react.
Right.
If we see a lot of inflation, we'll see interest rates go up. We don't want that. If we see unemployment, we'll see other adjustments, right? So we have to look at all those areas for the Fed to kind of balance those 2 out. Fixed income. Well, this is always not Brian's favorite for those of you who have investments with us, so I'm going to cover it. So fixed income is kind of the boring part of the curve, right? That's kind of the stuff that levels out. Thank you. The stuff that levels out the volatility. And really for the past, I would say 10 years, maybe more, fixed income is like it sucked,
probably 15.
Right? Yeah, it's been awful because interest rates are so low that where do we put the fixed money? Right. But you know what? Fixed income is now in the game.
It's back, for sure.
We're able to get 4 or 5% on fixed money.
Just in the last week, I've sent out 3 different bond portfolio proposals.
Yeah, people are looking at it. So
first time in a decade and a half.
We're going to start utilizing fixed income in the thing because we think that the Fed's going to be pretty stable. The yield curve is no longer inverted. Mm-hmm. We think that, a 10-year rate of 4 or 5% is good, right? People be happy that because, again, we lived through some pretty ugly times. Yep. So we think interest rates are going to be pretty much range bound, which is pretty good for fixed income. It leads to stability. Yeah. So
and it will also put us in a position where when the market has corrections, maybe it will not only money to buy in, but maybe it'll actually work the right way. When the stock market goes down, the bond market will go up. And when the bond market goes down, the stock market will go up. The way it used to be.
It is, but that's not the way the world works. It really based on interest rates, but we'll leave that alone. All right, so what could drive interest rates higher? again, if we get inflation, tariff-driven inflation is what everybody is worried about. That's a big issue in the news. Upside risk to potentially decreased government spending. We do think that, the government is trying to, we see them cutting stuff left and right. So they're going to try to spend less money and basically try to reduce our deficit. What could drive interest rates lower? The end of quantitative tightening, strong auction demand, which we do have a very strong auction demand for our paper. The reinstatement of the debt ceiling, which I think is going to happen in Congress. One of the two bills are going to have to pass. And increased volatility, which I kind of alluded to. I kind of expected.
Roller coaster?
Yeah, roller coaster.
Yeah.
All you.
Roller coaster, well, back-to-back 25+% years, if you were fully invested in the S&P.
That means you had nothing out of the market.
That's right. Fully invested in the S&P 500, which most of you are not fully invested in the S&P 500.
Because if you were and the market went down, you could lose 36%, which most of you would not be.
No, you would not be happy. But even with that said, the blended portfolios also did very good last year.
Yes.
And where do we anticipate 2025 going? Well, we're going back to that roller coaster conversation, right? But by the end of the year, we're assuming a 6,300, 6,375 on the S&P 500, which is about an 8% gain in the S&P.
Again, pretty tame.
Yeah. High single digits, not crazy, but not negative.
But it's the third year of a bull market. So a third year of a bull market is normally more tame.
Right. It would be odd to hit the bull probability. The bull case, which has a 30% probability, is 7,000. Now that's a 20% return. That would be the third year in a row of a 20% return. It's very, very uncommon. Not unheard of, but very, very uncommon.
And again, this is where the disruptor could make that happen.
Right. What are some things that could do it? Economic reacceleration, right? Margin expansion above expectations. Those PE levels just continue to go because the performance is there on the earnings side.
So accepting more like 24 or 30 times earnings
versus 17, 18, 19.
Yeah.
Right, exactly. And there's some companies out there, many of you would know the name NVIDIA, that's trading 50 times forward earnings.
Yeah, and people are still saying buy it.
Right. So we're not saying to sell NVIDIA, but adding to the position right now would seem odd, right?
Yeah.
But the bear case isn't so bad. The bear case is only an 8% loss. It's got a 20% probability of happening. And what are some things that could drive that? If inflation were to reaccelerate, we could see
the market will not react.
The market's not going to be happy because that's going back up in interest rates, which is not good for the market.
And to be honest with you, it's even the idea. So like the idea of if tariffs go in play, right?
Right.
If he actually,
that's inflationary, right?
Then even before it's inflationary, the market will assume it's going to be inflationary and we'll see that pullback.
Yep, for sure. And a strengthening dollar and weakening credit markets. Two more things that bring that bear probability as a possibility, right? But not likely. So 80% is base or bull, 20% is bear. That leads me to believe that overall 2025, we still anticipate, the analysts still anticipate
a positive
year.
Yeah.
Our continued message to you is it's not going to be in a straight line. It's not.
And you're going to have to stay invested.
Right.
Even when it feels ugly.
Yep.
That's why.
You go back to March of 2020, COVID happens, right? We have some horrible swings in the market, big downs. And if you called and said, I've got to get out of this market on those big down days, the very first day of the up, the market was up 2,000 points in one day.
If you missed it.
If you missed that one day, you may still not be fully recovered.
Yeah.
And that's why you can't have knee-jerk reactions to the market, which makes it more and more important to make sure that we have asset allocations correctly, which we're going to cover a little bit later. But it goes back to make sure the risk profile we have is right. Make sure that we're talking to you, you're talking to us about your expectations for risk.
Yes, and we're really getting a good read on that.
Yeah, so that's where we got to go.
So sectors, people always say, well, that's great, but where do we invest in it? And we do believe that 2025 is going to be a little bit more of a stock pickers market. And there's certain sectors we think that will do better, and sectors really we pick based on where we see the growth in earnings, right?
Yep.
So when we look at sectors, we know that technology's been a big sector for all of us, and honestly, that's where all the innovation happens. Everything happens in tech.
Well,
So
I talk about tech on appointments, and I talk about tech being the new blue chip.
it kind of is.
It really is. I mean, look at what we're doing today. We're talking to all of you through the computer instead of in person in a restaurant. Because we can, because we learned how, because we rely on technology to communicate more and more and more every day. And not just to communicate, but everything else.
But the other thing, if you think about tech, like when the market went down, what was the first sector to come back? Tech, always. It is always the first on the recovery. It leads out the recovery.
Absolutely.
So I think that's it. So tech is still going to be a sector for us.
Big one.
We also think that infrastructure, industrials. We've got issues where, our defense is really decimated. We need more stuff, right? Between what we gave to Ukraine, the Middle East, and other countries' armies like China are just building left and right. We need to keep up. So industrials we think are going to be very important. Also with, AI, right? We have to build places that these supercomputers can be, and then the electricity and the infrastructure for it. All that needs to be built out, as well as healthcare. We still have the aging of America.
Well, you got not only do we have the aging of America, but healthcare has been out of favor for so long.
And how many times do we see what's out of favor before it comes back and leads out?
Goes to the top, exactly. I mean, you go to those old charts we used to get.
The Callan chart.
The Callan periodic table of investments, bottom two were up to the top. They might be down there for 2-3 years and then they pop.
Yeah.
Healthcare's been down towards the bottom for 4 years.
Yeah, so it's time. So those are areas that we're gonna have obviously an array of sectors, but where we're gonna lean a little heavier is in technology, industrials, and healthcare.
Yep.
Right? And again, I say that it's because of, it's because of the earnings, and with strong earnings tracks. And if you look at the top three, you're gonna see they're technology, healthcare, and industrials. Right? So that kind of gives you an idea of where you're gonna see some of the asset allocation. In addition to that, we talk about the capitalization, which those are big words, right? But capitalization means really the size of the companies we invest in.
Exactly.
If you look at what's really led the market over the past couple of years, it's been large cap, mega. Yeah.
Right.
Big fat companies, they've been the leaders. And they've had so much growth that you have to kind of say to yourself, can they keep up the pace, right? Can they keep going? And then we have mid cap, which really, they're big companies, but then we have small cap. We really think that 2025 is going to be the year of the mid cap.
Yep.
And the reason that is because we look at, next slide, we look at the earnings of it, and then the earnings ratio as well as the number of times multiple. You'll see that large cap is really trading about 25 times, and small cap is trading about 19, but mid cap's only trading 18. The other thing is, remember I talked about the disruptor administration. It's very much an America First story, right? That's where everyone thinks all the growth is going to happen in here. This is where the deregulation, the positive tax policy for the businesses. We even see businesses already start coming back to the U.S.
Yep.
Mid caps are 76% U.S. based companies.
Yep.
Large cap are only 59%, and small cap, even though they're 80%, they need money, right? And maybe interest rates are still a bit high for them.
Right.
So we think mid cap will be the sector that we want to favor in 2025.
Yep.
Well, I kind of led you in international.
Yeah. Well, you know how much we've always loved international. If you've been with us for a long time, you probably still don't own international stock.
They own a little.
Bottom line, that's going to continue. But why? Because we do see positive growth in the U.S. economy. We do believe that the U.S. economy is going to continue to lead the global markets, the global economy. And when the U.S. economy continues to perform, when the U.S. economy continues to be relatively predictable, why take the risk of going somewhere else?
Yeah, I think, again, going back to policies, we're going to see a lot of pro-America stuff, right? They're talking about actually even decreasing the corporate tax rate. Last time President Trump was president, you saw a repatriation if you brought your company back to the US, I think he's going to put policies like that in play.
One would think.
He doesn't care about getting elected again, so he doesn't really doesn't matter to him. So I think we're going to see a lot of that stuff come back in.
Very true. And, if you look at,
The
the charts, it just shows the US just outperforms consistently in everything.
So why add the risk?
Right.
I know diversification is important. I'm a big believer,
But
but
we can diversify domestically,
yeah,
and we do. In adding risk in markets, in economies, in countries where you don't see the news every day. You don't know what's going on every day.
it's just not worth the reward to me.
Right.
I mean, I just don't
The
see it.
upside isn't there with the
And
economy.
honestly, the analysts don't like it either.
That's right. That's right. So once again, we're staying domestic.
So now we go back to risk management. And this is something that we talk about all the time, right? Managing risk.
Yep.
And this is extremely important because sometimes people get greedy in their head. They're like, oh, we want to make more. But then when the market goes down, what do they want to do? They want to sell. Or we get that phone call
That's
going.
why you got to match the ride to you.
Right, match the ride to you. So we think it's going to be volatile, definitely more volatile than last year.
Mm-hmm.
So that being said, your asset allocation, your diversification needs to match the risk that you can handle, which means in any given statement, you could see an amount of money go off your statement that you're not happy with.
Right.
It has to be, it's okay to not be happy. I'm not happy every day either. But the point is that
I hadn't noticed.
the point is that you have to be able to handle the ride. You can't just sit there and go, I need to get off. Because sometimes you're in the middle of the roller coaster and it's a
the
really
wrong time.
bad idea to get off. So we're talking about this because we want people on their reviews to really think about the risk.
Right.
And I know when I do the appointments, I always talk about, well, what if you got a statement and you lost 20,000, 50,000, 100,000? How would you react? And the reason we have these conversations is because that's one statement. It's one day in time. It could even be better from the moment you meet with me.
Right.
But that day, that statement is ugly. So the point is we want to make sure that you match the ride. We look at your asset allocation. We make sure that you're not just thinking about the up, but you're thinking about
The down.
the down.
The ups take care of themselves. We've always said that. The
Yeah, no
ups
one
will
ever
take care of
complains.
themselves as long as we manage the downs. And if we can build your portfolios or with the appropriate asset allocation to manage the risk that you can tolerate, you will always be comfortable with the ups.
Yes, and you'll be able to maintain. The average investor in the US only averages about 3.6%.
Because they play the in and out game.
Right. They think they can time the market.
Right.
It's not timing the
It
market.
can't be done.
It's time in the market.
Right.
Right? You cannot time. I don't care. You can get lucky at any given time. Any one of us can. It's kind of like getting a good lottery ticket.
Mm-hmm.
But it doesn't mean it's going to happen on a regular.
Right.
So that leads to asset allocation, right? When we talk about asset allocation, we talk about the mix between the different asset classes. In equities, it's large cap, mid cap, small cap, right? It talks about bonds, it talks about treasuries, it talks about corporates, utilizing cash, right? Money market accounts, a lot of you have seen us utilize that. I'm a big proponent. If you want to give me 4 or 5% on liquid money and I don't have to lock it up,
No risk.
I'm in. So the point is that we're going to utilize whatever asset classes as well as alternatives, right?
Mm-hmm.
We're going to be looking at some MLPs this year, some gold, a little bit of Bitcoin ETF. We're going to diversify. We're going to spread the risk. Not a lot in any one area because
Diversification is a big key this year.
Right. We don't know what's going to do
Mm-hmm.
great. So we're going to diversify. And why is diversifying so important? Is because nobody knows what is going to do well on any given day. The only purpose of diversification is risk mitigation.
Yep.
Again, I always say this, we can never eliminate risk. We can mitigate it. That's it. It allows us to deal with the unpredictability of the market. It allows us to have patience in the market and really strategic decision making. I mean, is every decision we're ever going to make correct? No, I wish it was, but then neither one of us would be
I
working.
thought a million times you've told me every decision you've ever made is correct.
Only with you. But investment-wise, not so much. But sometimes we're going to hit it out the park. So the point is that.
But that's why that goes back to diversification.
Yes.
We may buy something that just goes phenomenal.
Yeah. And then we may buy something that was just a
That
bad
doesn't.
decision. The important thing is that we diversify so no one thing
Makes or breaks it.
makes or breaks it. So diversification is extremely important, and we really focus on that, and we want you guys to focus on that. So when a lot of you come to us and say, why do we have 82 holdings in this? Can't we have 5? The answer is no.
No.
We do it because we need to diversify. So hopefully all of you found this to be really valuable, and it kind of gives us an opportunity to talk to all of you at one time and tell you a little bit about our thoughts on the market for 2025. In addition to that, as I said before, education is how we always built our business. That's how we got most of you to be our clients. Something that I love to do, we both love to do.
And we're coming back to it this year.
Yeah, this is our focus. We're gonna get on video, and we're gonna talk to you guys about different topics. So send in your topics, but not only send in your topics, invite your friends, invite your family to watch these.
And share the experience.
Share the experience of the legacy team. I was almost saying legacy financial planning.
Going back to our roots.
The legacy team at Wealth Enhancement Group. This is extremely important because most people don't know this information, and they really do need it. And we try to keep it in pretty simple language. So I hope all of you enjoyed it. We wish each one of you a happy and prosperous 2025. And
thanks for taking the time today.
Thanks for taking the time, and call in for your reviews if you're due, because we definitely want to talk to you. Have a good night.